There is a single, almost invisible line that separates the merely wealthy from the truly generational fortunes. It isn't luck, it isn't inherited genius. It is a shift in perception so profound, yet so simple, that most investors walk right past it their entire lives, stepping over diamonds while they dig frantically in the dirt for discarded pennies. For decades, the most famous investor in the world, Warren Buffett, was one of them. He was a master of the discarded penny. He built his first millions by rooting through the market's ashtray, looking for what he called cigar butts, those beaten-down, statistically cheap businesses that had one last free puff left in them. He was brilliant at it. He was successful. But he was not yet on the path to becoming the oracle, the legend, the multi-billionaire. He was trapped on the ground floor of wealth, a place where you have to work relentlessly for every single dollar. The key to the penthouse, the key that would unlock not just millions but tens and then hundreds of billions, was not in his hands. It was in the mind of his partner, a man named Charlie Munger. And the philosophy Munger championed was so counterintuitive to everything Buffett had learned it was almost heretical. It was a simple sentence that would rewire the entire financial world. Stop looking for fair companies at a wonderful price. Start looking for wonderful companies at a fair price. This wasn't just a new tactic. It was a new religion. It was the fundamental realization that the quality of the business you own is the ultimate engine of long-term returns, far more important than the statistical cheapness of the price you pay. It is the secret that separates those who get caught in endless value traps, stocks that are cheap and stay cheap forever, from those who harness the unstoppable power of true compounding. Today, we are not just going to study this principle, we are going to install it into your operating system. We will deconstruct the Munger shift piece by piece until it becomes an automatic part of your own executive decision-making, forever changing how you view the landscape of business and investing. This is the story of the pivot that created the Berkshire Hathaway we know today, the single most important lesson in modern wealth management, and the final promise of an investment philosophy that truly leads to financial freedom. The world of investing, particularly in the mid-20th century, was dominated by a single ghost, the ghost of the Great Depression. It haunted every ledger, every transaction, every stock quote. For the generation that lived through it, the cardinal rule was not to make money, but to not lose it. This philosophy was codified by the high priest of value, Benjamin Graham, a professor at Columbia University whose book, The Intelligent Investor, became the Bible for a generation of shell-shocked financiers. Warren Buffett was his greatest disciple. Graham's method was one of extreme, almost paranoid, quantitative safety. He taught his students to be financial archaeologists, digging through corporate financial statements to find businesses trading for less than the liquidation value of their assets. The holy grail was the net, a company whose market capitalization was less than its net current assets. Essentially, you were buying the inventory, cash, and receivables for free, and getting the buildings and machinery as a bonus. It was a strategy born from an era when companies regularly went bankrupt, and your only protection was the tangible scrap value of what you owned. This was the world that forged the young Warren Buffett. After leaving Graham's tutelage, he returned to Omaha and started his investment partnerships, and he practiced the gospel of Graham with ruthless efficiency. This was the era of the cigar butt. The analogy was vivid. You walk down the street and find a discarded cigar butt on the ground. It's soggy, it's ugly, but there's one good puff left in it. You can pick it up, take that one free puff, and then throw it away and look for another. It's not elegant, but it's free. Buffett's partnerships were a portfolio of these free puffs. A foundational anecdote that perfectly captures this era is the saga of the Dempster Mill Manufacturing Company. In 1956, Buffett found this small, sleepy manufacturer of windmills and farm equipment based in Beatrice, Nebraska. To the casual observer, it was a dying business and a tough industry. But to Buffett, looking through his Graham-tinted glasses, it was beautiful. The stock was trading around $18 per share. But Buffett's analysis showed that the company's net working capital, its current assets minus all its liabilities, was over $72 per share. He was buying $1 of easily sellable assets for less than 25 cents. It was a classic cigar butt. He began buying the stock aggressively. Over the next 5 years, his partnerships accumulated a controlling stake in the company. But here's where the cigar butt analogy starts to fray. That one free puff doesn't just jump into your mouth. You have to fight for it. The management at Dempster was entrenched and inefficient. They were sitting on a mountain of excess inventory, bleeding cash, and running the business like a personal fiefdom rather than a shareholder-owned enterprise. So Warren Buffett, the passive investor, had to become an activist. He got himself on the board. He fought with management. He cajoled. He argued. He pushed. It was a grueling, time-consuming battle. Eventually, he forced a change. He brought in a sharp, cost-cutting manager named Harry Bottle. Bottle was a whirlwind. He slashed unnecessary inventory, sold off assets, and squeezed every last drop of cash out of the business. Within a couple of years, the capital that had been trapped inside Dempster Mill was freed, the stock price rose, and Buffett's partnerships exited with a handsome profit, roughly tripling their investment. On paper, it was a home run, a textbook Graham and Doddsville operation. But for Buffett, it left a bitter aftertaste. He had won, but the victory felt hollow. He had spent years of his life, an enormous amount of intellectual and emotional energy, to get one good puff out of a truly terrible business. Once the cash was extracted, the cigar butt was extinguished. Dempster Mill had no future, no competitive advantage, no growth potential. It was a one-time liquidation, not a long-term investment. He had to take all that money and immediately start the whole exhausting process over again, searching for the next soggy cigar butt. The experience planted a seed of doubt in his mind. Is this really the best way to get rich? Is my time best spent fighting with mediocre managers of mediocre businesses, or is there a better game to be playing? The psychological gravity that pulls investors, even brilliant ones like the young Buffett, into the orbit of cigar butts is immense and multifaceted. At its core is a powerful cognitive bias known as the anchoring effect. Our brains are wired for shortcuts, and when we're presented with a piece of information, especially a number, we tend to latch onto it or anchor and view all subsequent information through its lens. In investing, the anchor is often the price. A stock trading at $5 per share feels cheaper and seems to have more upside than a stock trading at $500. A company with a price-to-earnings ratio of 6 feels like a bargain compared to one with a PE of 25. These low numbers become powerful psychological anchors. We become fixated on the statistical cheapness, and this fixation blinds us to the most important question. Why is it cheap? The market is not a benevolent charity, handing out $100 bills for 20. More often than not, a business is cheap for a very good reason. It might be in a dying industry. It might have incompetent or corrupt management. It might have a fatally flawed business model, or its products might be on the verge of obsolescence. But the anchor of that low price is so strong that it encourages us to rationalize away all the bad news. We tell ourselves, all of this negativity must be priced in. It can't possibly go any lower. This is the siren song of the value trap. Compounding this is the scarcity heuristic. We tend to place a higher value on things we perceive as scarce. A stock that has been beaten down and ignored by the market feels like a scarce, undiscovered opportunity. It's our secret. We feel clever for finding this gem that the rest of the world has overlooked. This feeling of being a contrarian, of being smarter than the crowd, is incredibly seductive. The problem is that sometimes the crowd is right. Sometimes, a business that looks like a forgotten treasure is actually just a pile of junk that everyone else was smart enough to avoid. The focus on tangible, easily quantifiable metrics like book value, which was the cornerstone of Graham's approach, exacerbates this. It provides a false sense of security. You can point to a number on a balance sheet and say, my margin of safety is here, in the liquidation value of the machinery. This is comforting. It feels scientific and disciplined. What it ignores are the intangible assets that truly drive long-term value in the modern economy: brand strength, network effects, intellectual property, and corporate culture. A cigar butt has no brand loyalty. It has no pricing power. It has no moat. It has only the scrap value of its component parts, and that value is often stagnant or declining. The focus on the asset side of the balance sheet leads to a complete neglect of the business's economic engine, or lack thereof. This is why the cigar butt approach is a recipe for mediocrity. It condemns you to a life of buying poor quality assets, hoping for a small, one-time pop in price. It's a strategy of flipping, not owning. It's intellectually and emotionally exhausting, and it fundamentally misunderstands that the greatest returns in history have not come from buying junk cheaply, but from owning pieces of truly extraordinary enterprises over long periods of time. To truly understand the mindset, let's translate this theory into a practical, step-by-step mental model. This is the blueprint for a pure, unadulterated cigar butt investor. If you wanted to replicate the strategy of the early Buffett partnerships, this is the instruction manual you would follow. The entire process is built around screening for statistical cheapness, prioritizing numbers over narrative, and assets over earnings power. Step 1 is the initial screen. You are not looking for good businesses. You are looking for low numbers. You would use a stock screener and set brutally simple criteria. The primary filter is price-to-book value, PB. You would set the maximum PB ratio to less than 1.0 and ideally less than 0.7. This means you are only looking at companies trading for less than the stated value of their assets on the balance sheet. A second filter would be a low price-to-earnings PE ratio, perhaps under 10, to ensure you're not overpaying for what little earnings the company might have. The most extreme version of this, the Holy Grail, is the net-net screen, where you filter for companies whose market capitalization is less than their net current asset value. Current assets, total liabilities. This requires a bit more manual calculation, but it is the ultimate expression of Graham's margin of safety. Step 2 is the quantitative deep dive. Once you have a list of statistically cheap companies, you ignore the story. You don't care what the CEO is promising on conference calls. You don't care about their new product launch. You go straight to the balance sheet. Your mission is to verify the assets. Is the inventory real and sellable, or is it obsolete junk? Are the receivables collectible from credit-worthy customers? You are acting as a pawnbroker, assessing the collateral. You are looking for hidden liabilities, like underfunded pension plans or potential lawsuits, that could erode the asset value. The income statement is of secondary importance. You might glance at it to see if the company is burning cash, but the primary focus is on the solidity of the balance sheet. You are buying a collection of assets, not a stream of future earnings. Step 3 is diversification and patience. Because you are buying low-quality businesses, you know that many of them will fail. Some will go to zero. The cigar butt will be completely waterlogged with no puff left. Therefore, you cannot concentrate your capital. You must buy a wide basket of these cheap stocks, 20, 30, maybe even 50 of them. The strategy relies on the law of averages. For every 2 or 3 that go bankrupt, you hope that 4 or 5 will get taken over, or liquidate, or see a small operational turnaround that allows their stock price to rise towards their tangible book value. You buy your basket, and then you wait. You are not waiting for a brilliant new strategy from management. You are waiting for an external event, an acquisition offer, an activist investor, or a cyclical upturn in a dying industry to unlock the value. Step 4 is the disciplined sale. The moment your cheap stock approaches what you've calculated as its fair value, its book value, or liquidation value, you sell without emotion, without hesitation. You do not fall in love with the company. You do not start believing in a miraculous turnaround story. Your thesis was that it was cheap. Now it is no longer cheap. The thesis is closed. You take your profit, which might be 30%, 50%, or if you're lucky, 100%, and you immediately redeploy that capital into the next name on your list of statistically cheap stocks. The entire process is a mechanical, unemotional cycle of buying assets for 50 cents on the dollar and selling them for 80 or 90 cents. It is a grind. It is a way to generate decent but not spectacular returns. But it completely closes the door to the possibility of owning a business that grows 100-fold over 20 years because you are programmed to sell it after the first 50% gain. It is the definition of picking up pennies in front of a steamroller. The antithesis of the cigar butt philosophy is not, as you might expect, buying wonderful companies at a fair price. That is the synthesis, the evolved state. The true, polar opposite is the path walked by the vast majority of retail investors today, especially in the heat of a bull market. It is the path of the pure, story investor who ignores not just quality, but valuation entirely. This is the path of the 99% who consistently underperform the market, chasing narratives instead of value. While the cigar butt investor is obsessed with the balance sheet, the story investor is obsessed with the dream. They are not buying a business, they are buying a ticket to the future. Their decisions are driven by hype, by compelling narratives of disruption, and by a crippling fear of missing out on the next big thing. Their research doesn't involve reading dense annual reports. It involves watching charismatic CEOs on YouTube, reading enthusiastic articles on tech blogs, and seeing a stock symbol mentioned repeatedly on social media. They suffer from the absolute reverse of the anchoring bias. They are not anchored to low numbers, they are repelled by them. A low PE ratio is not a sign of a bargain, but a sign of a boring, old economy company that has been left behind. They actively seek out astronomical valuations, price-to-sales ratios of 50, 100, or even companies with no sales at all, because these high numbers are seen as proof of the market's belief in the company's limitless potential. The story is so good, the addressable market so large, that any price is justified. This leads to portfolios concentrated in the most speculative, fashionable stocks of the day. They buy companies that are burning through mountains of cash, promising profitability at some distant point in the future. The justification is always the same. You have to pay up for growth, but they fail to distinguish between revenue growth and the creation of actual, durable economic value. A company can grow its revenues at 100% a year by selling dollar bills for 90 cents. This is growth, but it is value destructive. The story investor doesn't look at return on invested capital or profit margins. They look at user growth, download numbers, or any other key performance indicator that supports the ever-expanding narrative. The disastrous consequence of this approach is that it makes the investor extraordinarily fragile. They have no anchor of intrinsic value to hold on to. When the market narrative shifts, as it inevitably does, their entire thesis for owning the stock evaporates overnight. When a high-flying stock that they bought at 100 times sales falls by 50%, they have no framework to decide whether it's now a bargain or still wildly overvalued. They are paralyzed. Unlike the cigar butt investor who has the cold comfort of asset value, the story investor has nothing but a broken dream. Their portfolio becomes a graveyard of former high flyers, stocks they bought near the top that are now down 80 or 90%. They are left holding a bag of broken stories, a testament to the destructive power of buying hype without any regard for price or underlying business quality. It is a path paved with excitement, adrenaline, and ultimately, massive capital destruction. It is the opposite side of the same flawed coin as the cigar butt, both missing the crucial synthesis of quality and value. The financial manifestation of the cigar butt philosophy within an investor's portfolio is subtle but profoundly limiting. It creates a specific type of financial performance that is incredibly difficult to scale into true, life-altering wealth. The direct financial connection is not one of catastrophic loss, but of capped potential and relentless effort. Firstly, a portfolio of cigar butts is characterized by high turnover. The very nature of the strategy is to buy a cheap stock, wait for a small re-rating, and then sell. This constant buying and selling has significant financial friction. Each transaction incurs commission costs. More importantly, each sale triggers a taxable event. If the stocks are held for less than a year, which is common in this strategy, the profits are taxed as short-term capital gains, which are taxed at the investor's ordinary income tax rate, the highest rate possible. This is a massive, recurring leakage of capital that acts as a powerful headwind against the portfolio's long-term growth. It's like trying to fill a bucket with a hole in it. A significant portion of your gains are siphoned off by the taxman each and every year, preventing the full, untaxed power of compounding from taking hold. Secondly, this approach inherently limits position sizing and conviction. It is very difficult to have deep, unshakable conviction in a mediocre business. You might know it's statistically cheap, but you also know it's a terrible company. Therefore, you are forced to diversify widely, taking many small positions. You might put 2% of your portfolio in one cigar butt, 2% in another. This means that even when you are right, the impact on your overall portfolio is muted. A stock that doubles, going from 2% of your portfolio to 4%, is a nice win, but it doesn't move the needle in a transformative way. You are prevented from making the large, concentrated bets on high-quality businesses that are the true generators of legendary fortunes. Your portfolio becomes a sprawling collection of low-conviction ideas, an index fund of mediocrity. Finally, and most critically, the cigar butt model is fundamentally at odds with the magic of compounding. Compounding is the eighth wonder of the world, because it involves a great business generating high returns on its capital, and then retaining that capital to reinvest at similarly high rates. This creates a snowball of value that grows exponentially over time. A cigar butt, by definition, does not do this. It is a capital extractive exercise. You buy it, you hope the value is unlocked and paid out to you, and then the story is over. It does not retain earnings and reinvest them intelligently. The business itself is not a compounding machine. The financial result is a portfolio that might produce lumpy, decent returns, perhaps 15% one year, 5% the next, 20% the year after, but it is a linear, effort-based return. The investor is like a hamster on a wheel, constantly having to find new ideas to replace the ones they've sold. Their wealth grows through their active efforts, not through the passive, effortless growth of the wonderful businesses they own. They are forever trapped in the business of stock picking, rather than ascending to the level of business owning. This is the financial ceiling that Warren Buffett was pressing against, the invisible barrier that Charlie Munger was about to shatter for him. The year is 1972. Warren Buffett, now in his early 40s, is no longer running his small partnerships. He is at the helm of Berkshire Hathaway, a struggling New England textile manufacturer that he had bought as a classic cigar butt years earlier. It was a terrible business, and he knew it. He was now using the cash flows from Berkshire's insurance operations to make investments, but his mindset was still firmly anchored in the world of Ben Graham. He was still hunting for statistical bargains. Then, a unique opportunity crossed his desk, a company called See's Candies. See's was a family-owned, premium chocolate company based in California. It was a beloved, iconic brand on the West Coast, known for its black and white stores, its friendly service, and its high-quality old-fashioned candy. The See family wanted to sell, and they were asking for $30 million. Buffett, along with his longtime friend and intellectual sparring partner Charlie Munger, took a look. The numbers, to Buffett, were immediately problematic. The company's tangible assets, its factories, its stores, its inventory, had a book value of only about $8 million. The See family was asking for a price that was nearly 4 times the value of all the physical stuff you could touch and sell. To the trained Graham disciple, this was an immediate red flag. It was the polar opposite of a cigar butt. You were paying a huge premium over the asset value, not getting it at a discount. Buffett's instinct was to walk away. The price was simply too high. This is the moment of the intervention. This is where Charlie Munger changed the course of financial history. Munger saw something that Buffett, blinded by his focus on the balance sheet, was missing. He saw the invisible asset. He saw the power of the See's Candies brand. He understood that customers weren't just buying chocolate. They were buying nostalgia, tradition, quality, and trust. They were buying a feeling. And because of that feeling, See's had something that Dempster Mill manufacturing never would: pricing power. Every year, See's could raise the price of its candy by a little bit, and its loyal customers wouldn't blink an eye. They happily paid up because the product was associated with holidays, with gifts, with family. This small, consistent price increase on millions of pounds of candy created a torrent of cash flow that required almost no additional capital investment. Munger argued relentlessly. He pushed Buffett to think beyond the tangible assets. He told him, "Warren, you have to look at the economics of the business itself. This is a business that can grow and gush cash without you having to pour more money into it." He famously said that he and Buffett were like a matched pair of therapists, and it was his job to cure Buffett of his obsession with cigar butts. "It's better to buy a wonderful company at a fair price," Munger insisted, "than a fair company at a wonderful price." The debate raged. Buffett was deeply uncomfortable paying such a premium. But Munger's logic was chipping away at his old assumptions. Eventually, Buffett relented. They went back to the C family and negotiated the price down slightly to $25 million. They closed the deal. That $25 million purchase in 1972 was the single most important acquisition in Berkshire Hathaway's history, not because of its size, but because of what it taught them. C's Candies performed even better than Munger had predicted. It became a cash geyser. Buffett himself has stated that the initial $25 million investment has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, cash that required almost no additional capital to produce. That cash became the seed capital for countless other Berkshire investments. C's Candies became the prototype, the mental model for what a wonderful business looked like. It rewired Buffett's brain. He had paid a premium price, and in return, he had acquired an economic machine that would shower him with money for the next 50 years. The hard, grueling work of squeezing one last puff from Dempster Mill was replaced by the simple, elegant joy of owning a business that did the work for him. It was the epiphany. The old way was dead. The Munger way, the path of quality, was now the only path forward. The psychological shift that Munger induced in Buffett was a move away from the comfort of concrete numbers and toward the abstract, more powerful concept of an economic moat. A moat is a sustainable competitive advantage that protects a business from competitors, much like a moat protects a castle. Munger understood that the most valuable asset a company can have is not a factory or a pile of inventory, but a durable moat. The power of the C's Candies brand is a classic example of a moat built on an intangible asset, and recognizing its value requires overriding several cognitive biases. The primary bias that the Munger shift overcomes is what's known as tangibility bias. Our brains have a preference for things we can see, touch, and easily measure. A factory is tangible. A patent is tangible. A brand, customer loyalty, a strong corporate culture, these are intangible. They don't appear on the balance sheet at their true value. An accountant might value the C's brand at zero, but a business thinker like Munger understood its economic value was in the tens, if not hundreds, of millions. This is about seeing the invisible reality behind the visible accounting fiction. It's the ability to appreciate that the collective thoughts and feelings about a product in millions of customers' minds, what Buffett would later call share of mind, is a far more valuable asset than a building. Furthermore, this new philosophy leverages the power of habit and association, two deeply ingrained psychological principles. C's Candies wasn't just a product, it was a ritual. People bought it for Christmas, for Valentine's Day, for birthdays. It became associated with positive life events. This created a powerful habit loop. When a special occasion arose, the automatic thought was, I need to go to C's. This is a marketer's dream, but it's also an investor's paradise. A business built on habit is incredibly resilient. It's insulated from the day-to-day fluctuations of the economy. People might cut back on a new car, but they will still buy that 1-pound box of chocolates for their mother's birthday. This creates a predictable, reliable stream of earnings that is the hallmark of a high-quality business. This mindset also forces an investor to think about the second and third-order consequences of a business's characteristics. A cigar butt investor asks, what are the assets worth today? A quality investor asks, What does this brand's pricing power imply about future cash flows for the next 20 years? It's a shift from a static snapshot analysis to a dynamic, long-term projection of a company's economic trajectory. It requires what Munger calls worldly wisdom, the ability to draw on models from multiple disciplines, including psychology, to understand how a business really works in the real world. You have to understand that a powerful brand creates a psychological barrier to entry for competitors. A new chocolate company could build a factory, but it could not replicate the 50 years of happy memories that customers associated with the C's brand. That is the moat, and it is a psychological one. By forcing this perspective, Munger taught Buffett to pay for predictability, durability, and the near certainty of future cash flows, rather than hunting for the statistical illusion of a bargain in the scrap heap of the market. So how does an ordinary retail investor or entrepreneur apply this monumental shift in thinking? How do you build a practical blueprint for identifying these wonderful companies? This is the Wonderful Company Checklist, a mental model that translates the Munger philosophy into an actionable investment process. It consists of 4 distinct sequential filters. If a company does not pass all 4, you move on, no exceptions. The first filter is the simplest and most important. Is it a business I can understand? This is what Buffett calls the circle of competence. It doesn't mean you need to be an expert who can build a semiconductor from scratch. It means you need to have a solid grasp of how the business makes money, what its competitive advantages are, and what the key drivers of its future success will be. Can you, in a few simple sentences, explain to a 10-year-old why this company will be bigger and more profitable in a decade? If the business involves complex financial derivatives, obscure biotechnology, or a technology you don't use or understand, you must pass. This isn't about intelligence, it's about intellectual honesty. Investing outside your circle of competence is not investing. It is gambling. The second filter is to assess the company's long-term economics. This is the search for the moat. You are looking for businesses with favorable, durable characteristics. The key indicator here is a consistently high return on tangible equity, or return on invested capital, ROIC. A wonderful business is one that can earn high rates of return on the money it invests in itself. You also want to see a business that does not require massive, continuous capital expenditures just to stay competitive. C's Candies was a perfect example. It could grow its earnings without having to build dozens of new factories. You should ask, does this business have pricing power? Can it raise prices without losing customers? Does it benefit from a strong brand, a network effect, high switching costs for its customers, or a significant cost advantage over its rivals? You are looking for a business that has a long runway for growth and is protected by a deep, sustainable moat. The third filter is an evaluation of management. Are the leaders of the company able and trustworthy? You are looking for 2 things here: talent and integrity. On the talent side, you want to see a management team with a long track record of operational excellence and intelligent capital allocation. Do they reinvest the company's earnings wisely, or do they squander them on overpriced, foolish acquisitions? You can find this out by reading their past annual reports and shareholder letters. On the integrity side, you want to see managers who think like owners. Do their incentives align with yours as a shareholder? Do they communicate with shareholders candidly and transparently? Are they passionate about the business, or are they just there to collect a paycheck and cash in their stock options? Buffett says he looks for managers who he would be happy to have his daughter marry. You are entering into a long-term partnership with these people. You must trust them implicitly. The fourth and final filter is the price. The Munger mantra is to buy a wonderful company at a times fair price. It is not to buy a wonderful company at any times price. This is where discipline is critical. Once you have identified a wonderful business with great economics and terrific management, you must calculate its approximate intrinsic value. You can do this using a simple discounted cash flow analysis, or by looking at what a rational private buyer would pay for the entire business. Then, you wait. You wait for the market, in its periodic fits of pessimism or panic, to offer you a chance to buy that business at a significant discount to its intrinsic value. This is your margin of safety. You don't have to swing at every pitch. You can wait for the perfect fat pitch, right in your sweet spot, and only then do you commit your capital. By patiently and rigorously applying these 4 filters, you transform yourself from a speculator into a true business owner. The antithesis to this disciplined pursuit of quality is a common and destructive path in the corporate and investment world, the path of the diversifier. This term, coined by legendary investor Peter Lynch, describes the tendency of companies, and by extension, the investors who buy them, to expand into areas they don't understand, ultimately destroying shareholder value. It is the perfect illustration of what happens when the focus shifts from quality to sheer size. The diversifier is the manager or investor who believes that bigger is always better. They are obsessed with growth for growth's sake. Instead of focusing on deepening the moat of their core wonderful business, they get distracted by empire building. A classic example is a successful company in, say, the beverage industry. They have a great brand, great economics, and they are gushing cash. A wise manager would either reinvest that cash into strengthening their beverage moat or return it to shareholders. The diversifying manager, however, gets bored. They see a hot new industry, perhaps technology or media, and they decide they need to be a part of it. They then take the shareholders' cash, generated from the wonderful core business, and make a massive, overpriced acquisition of a mediocre company in an industry they know nothing about. The result is almost always a disaster. The synergies they promised never materialize. The cultures of the 2 companies clash. The management team, now stretched thin, takes its eye off the core business, which begins to decline. They have taken a wonderful company and diluted it with a fair or poor one, and the result is a larger but far less profitable and less focused enterprise. This happens constantly in the corporate world. Investors fall into the same trap. They might own a wonderful business like Coca-Cola or American Express, but they get impatient with its steady, predictable growth. They hear stories about other investors getting rich quick in speculative ventures, and they feel like they're missing out. So they sell a piece of their wonderful business to buy a story stock with no earnings and no moat. They are actively choosing to dilute the quality of their own personal portfolio. They are diversifying. This behavior is driven by a deep-seated action bias, the psychological need to be doing something. The patient ownership of a wonderful company can feel passive and boring. The thrill of the deal, the excitement of a new venture, is far more stimulating. But this pursuit of stimulation often leads to the destruction of capital. The diversifier fails to appreciate the profound power of focus and the incredible value of a dominant position in a single great business. They trade the near certainty of long-term compounding from their core holdings for the low-probability lottery ticket of a new, exciting but ultimately inferior venture. This is the opposite of the Munger approach, which is about intense concentration in a few things you understand deeply. Diversification is the path of spreading your capital and attention thinly across many mediocre ideas, ensuring that your long-term results will also be mediocre. The financial transformation that occurs when an investor makes the Munger shift is nothing short of breathtaking. It changes the entire financial architecture of a portfolio, moving it from a model of linear, effort-based returns to one of exponential, ownership-based growth. The direct financial connection can be seen most clearly through the story of See's Candies' impact on Berkshire Hathaway's balance sheet and capital allocation strategy. When Berkshire bought See's for $25 million, it wasn't just buying a stream of profits, it was buying a self-fueling engine of capital creation. Let's look at the numbers. The initial investment was $25 million. In the early years, See's was earning about $5 million a year pre-tax. A cigar butt investor, upon seeing the value of the company rise to say $50 million, would have sold, booking a nice 100% gain and locking in a taxable event. But Buffett, now under Munger's influence, held on, and the magic began. Because See's had immense pricing power and low capital needs, those profits grew year after year, without requiring Buffett to inject more money. By the early 2000s, See's was generating over $80 million in pre-tax profit annually. Think about that. Every single year, the business was generating more than 3 times the original purchase price in cash that could be sent directly to Berkshire's headquarters in Omaha. To date, as Buffett has confirmed, that initial $25 million investment has returned over $2 billion to Berkshire. This is a return of 80 to 1, and it's still growing. But the true financial genius is what happened next. This is the masterstroke of capital allocation. That reliable, ever-growing stream of cash from See's became the fuel for Berkshire's other acquisitions. The profits from selling chocolates in California were used to buy shares in Coca-Cola. The profits from Coca-Cola were used to buy a railroad. The profits from the railroad were used to buy a massive energy utility. See's Candies became the cornerstone of a financial flywheel. It was the first wonderful company that gushed cash, which Buffett could then use his genius to allocate into other wonderful companies. This is how true wealth is built. It's a two-step process. First, own a high-quality business that produces more cash than it needs to operate. Second, take that excess cash and intelligently reinvest it into other high-quality assets. This creates a compounding effect that is almost impossible to stop. Your portfolio ceases to be a static collection of stocks and becomes a living, growing organism, where the successful parts are constantly funding the expansion and acquisition of new successful parts. This is a universe away from the financial reality of the cigar butt investor, who is stuck in a loop of selling one cheap asset to buy another, with taxes and transaction costs eating away at his returns every step of the way. The Munger shift is the key that unlocks the door from the hamster wheel of active trading to the effortless ascent of long-term ownership. To truly master the Munger shift, we must go deeper than simply identifying a company with a good brand. We must dissect the very anatomy of a wonderful business to understand the specific economic structures that create these compounding machines. There are a handful of powerful recurring patterns, competitive moats, that are responsible for almost all of the world's great business dynasties. The ultimate case study in identifying and capitalizing on one of these moats is Buffett's monumental investment in the Coca-Cola Company in 1988. The timing of the investment is crucial. In October 1987, the stock market had experienced Black Monday, the single worst crash in its history. Fear was rampant. Investors were dumping stocks indiscriminately, convinced that a new Great Depression was at hand. Lesser investors were panicking, selling everything. Buffett, armed with his new Munger-inspired mindset, saw it as an opportunity of a lifetime. He wasn't looking at stock charts. He was looking at the underlying business reality of Coca-Cola. He had been a consumer of the product for 50 years, drinking at least 5 Cokes a day. He saw the product's ubiquity. He could travel to any corner of the globe and find someone enjoying a Coke. This wasn't just a beverage, it was a global institution. He began a deep, methodical analysis. He talked to competitors. He visited local bottlers. He read decades of annual reports. What he saw was a business of almost unparalleled perfection. It had a tiny amount of tangible assets. It was essentially a company that sold a secret syrup formula and a brand name. The heavy lifting of bottling and distribution was done by others. This meant Coca-Cola had incredibly high profit margins and required almost no capital to grow. But the true source of its wonder was the moat, its brand. The name Coca-Cola was arguably the most valuable piece of commercial real estate in the world. The real estate inside the human mind. People all over the world associated Coke with happiness, refreshment, and America. This share of mind was a nearly impenetrable barrier to competitors. A new soda company could build a factory and create a formula, but it could not buy its way into the brain of billions of people. This brand power gave Coca-Cola immense pricing power, allowing it to consistently raise prices just ahead of inflation, turning its profits into a constantly growing stream of cash. So, in the midst of the post-crash fear, Buffett acted with conviction. Over a period of several months in 1988, Berkshire Hathaway invested over $1 billion to acquire a significant stake in Coca-Cola. It was one of the largest single investments ever made at the time. Many on Wall Street thought he was crazy, paying what seemed like a premium price for a boring old company. But Buffett wasn't buying the stock, he was buying a piece of the business, a business he understood to be one of the finest on earth. That $1 billion investment has since paid Berkshire tens of billions of dollars in dividends alone, and the original stake is now worth well over $20 billion. It was a testament to the Munger philosophy: find an utterly wonderful business with a dominant, unshakable moat, and then, when the market offers you a fair price, back up the truck. The extraordinary success of a business like Coca-Cola is not an accident. It is the result of powerful forces, both economic and psychological, converging to create an outcome that is far greater than the sum of its parts. Charlie Munger has a name for this phenomenon: the Lollapalooza effect. It's what happens when multiple cognitive biases and mental models are all working in the same direction, reinforcing each other and creating a massive self-amplifying feedback loop. A truly wonderful business is a Lollapalooza effect in commercial form. Let's break down the psychology behind Coca-Cola's dominance. First, you have the power of classical conditioning. Just like Pavlov's dogs, for over a century, Coca-Cola's advertising has brilliantly associated the product with positive human emotions: happiness, togetherness, celebration, refreshment. The iconic "I'd like to buy the world a Coke" ad, the famous polar bears, the open happiness campaigns, they all work to create a powerful subconscious link. See the red logo? Feel a slight pang of happiness. This isn't an accident, it's billions of dollars of psychological programming. Second, you have the force of social proof. When you see a product everywhere, being consumed by everyone from presidents to pop stars to your own family members, you instinctively assume it must be good. This ubiquity creates a powerful pressure to conform. Choosing a Coke is the easy, default, socially accepted option. This reduces the cognitive load for the consumer. They don't have to think, they just order. This effect is a massive barrier to entry for any new competitor. To compete with Coke, you're not just fighting a company, you're fighting a global social convention. Third is the impact of sheer availability and distribution. This ties into the availability heuristic, our tendency to judge the importance of something by how easily it comes to mind. Coca-Cola's distribution system is a global marvel, ensuring that you are never more than an arm's reach away from a Coke. It's in vending machines, restaurants, supermarkets, and tiny corner stores in the most remote parts of the world. This constant presence reinforces its dominance in our minds and makes it the most convenient choice. Finally, all of these factors combine to give the company its ultimate weapon: pricing power, which is rooted in the psychology of perceived value. Because of the brand's association with quality and happiness, consumers are not particularly price-sensitive. A 10-cent increase in the price of a can of Coke is almost unnoticeable to the individual, but when multiplied by billions of transactions, it results in hundreds of millions of dollars flowing directly to the company's bottom line. The Lollapalooza effect is the combination of all these forces: the conditioned emotional response, the power of social proof, the ease of availability, and the resulting low price elasticity, all working in concert to create a business that is a virtually unstoppable economic juggernaut. This is the deep, psychological anatomy of a wonderful company, and it's a force that a simple cigar butt can never hope to replicate. To make this practical, we need to translate the abstract idea of a moat into a concrete framework that any investor can use. The Four Moats framework is a powerful mental model for categorizing and identifying the specific types of sustainable competitive advantages that allow businesses to fend off rivals and generate high returns on capital for decades. If you are analyzing a potential investment, you must be able to clearly identify which one or more of these moats it possesses. The first moat is intangible assets. This is the category where brands, patents, and government licenses reside. A brand like Coca-Cola's or See's Candies is a claim on a piece of the consumer's mind. It creates trust and pricing power. A patent, like those held by a pharmaceutical company for a blockbuster drug, grants a legal monopoly for a set period of time, allowing for enormous profits. A government license, like the exclusive right to operate a landfill or a television station in a specific city, can also create a powerful local monopoly. The question to ask is, does this company have a unique asset that competitors cannot legally or economically replicate? The second moat is switching costs. This advantage exists when it is too expensive, time-consuming, or risky for a customer to switch from your product to a competitor's. Think about the software that runs a large corporation's entire accounting system. Even if a slightly better, cheaper alternative comes along, the cost and risk of migrating all the data and retraining thousands of employees is so immense that the company will almost certainly stick with their current provider. Banks also benefit from this. The sheer hassle of moving all your direct deposits, automatic payments, and account history keeps most customers from switching, even if they're unhappy. The question to ask is it a pain for my customers to leave me? The third moat is the network effect. This is one of the most powerful moats in the digital age. A business has a network effect when its product or service becomes more valuable as more people use it. The classic example is a social media platform like Facebook, or a credit card company like American Express. The value of Facebook to a new user is proportional to how many of their friends are already on the platform. The value of the American Express network to a merchant is how many cardholders there are, and the value to a cardholder is how many merchants accept the card. This creates a powerful, self-reinforcing cycle that leads to a winner-take-all dynamic. The question to ask is, does my product become better for each user when another user joins? The fourth moat is a cost advantage. This is when a company can produce and deliver its products or services at a consistently lower cost than its rivals. This can come from several sources. One is economies of scale, where a company's massive size allows it to negotiate better prices from suppliers or spread its fixed costs over a larger volume, like Walmart or Costco. Another source is a unique process advantage, like the Toyota production system, which revolutionized manufacturing efficiency. A third could be access to a unique, low-cost source of raw materials. This cost advantage allows the company to either undercut its rivals on price or to maintain the same price and earn much higher profit margins. The question to ask is, can this company do what it does cheaper than anyone else, and is that advantage sustainable? A truly great business will often have more than one of these moats. But if you cannot clearly articulate and defend the existence of at least one, you are likely looking at a mediocre business, not a wonderful one. The path of the 99%, the most common mistake made by those who try to apply the concept of quality investing, is to get caught in the growth trap. This is the critical error of confusing a fast-growing business with a high-quality, wonderful business. The two are often not the same, and the inability to distinguish between them is a primary cause of major investment losses. A company in a growth trap is one that is chasing revenue growth at any and all costs, often without any regard for profitability or long-term returns on capital. The narrative is always exciting. They are disrupting a massive industry. They are acquiring users at a breakneck pace, and their sales are doubling every year. Investors see these headline growth numbers and, driven by a fear of missing out, they extrapolate this growth far into the future and pay astronomical prices for the stock. The problem is that growth without a moat is worthless, and often it's destructive. Imagine a new airline that decides to gain market share by offering tickets at 50% below the price of all its competitors. Its revenue growth would be spectacular. It would quickly become one of the fastest-growing airlines in the country. But is it a wonderful business? Absolutely not. It is losing a huge amount of money on every single customer. The airline industry is notoriously competitive, with no real moat. As soon as this new airline tries to raise its prices to a profitable level, its customers will flee to the next cheapest option. It has no brand loyalty, no switching costs, no durable advantage. It is simply buying revenue growth with shareholder capital, a strategy that inevitably leads to bankruptcy. This is the essence of the growth trap. Investors see the top-line revenue growth and mistake it for progress, without looking at the underlying economics. They fail to ask the crucial question, is this profitable growth? Is the company generating a high return on the new capital it is investing to fuel this expansion? More often than not, the answer is no. These companies burn through enormous amounts of cash, constantly having to raise more money from investors just to stay afloat. They are on a treadmill, where the faster they run, the more money they lose. The dot-com bubble of the late 1990s was a massive, market-wide growth trap. Investors paid billions for companies like Pets.com or Webvan, which had fantastic revenue growth but a fatally flawed, unprofitable business model with no moat. When the capital markets dried up, they collapsed almost overnight. The lesson is clear and critical. Revenue growth is only valuable if it is attached to a business with a durable competitive advantage. Otherwise, it is a mirage, an illusion of success that masks a deep, underlying economic rot. A truly wonderful business might grow more slowly, but its growth is profitable, sustainable, and protected by a moat. It is creating real, long-term value, not just temporary, flashy sales numbers. The single most powerful financial metric for cutting through the noise and identifying a true compounding machine is return on invested capital, or ROIC. While most investors are focused on earnings per share or revenue growth, the most sophisticated business analysts understand that ROIC is the ultimate measure of a company's economic engine. It tells you how efficiently a company is using its capital to generate profits. In its simplest sense, ROIC answers the question: for every dollar I invest in this business, how many cents of profit does it generate for me each year? The formula is straightforward. You take the company's net operating profit after taxes and divide it by its invested capital, which is essentially the total debt and equity the company has used to build its assets. A high ROIC consistently above 15% or 20% is the financial signature of a wonderful business with a strong moat. Let's contrast two hypothetical businesses. Company A is a steel manufacturer, a classic cigar butt type of business. To generate $100 million in profit, it needs a massive, $1 billion factory full of expensive machinery. Its ROIC is 10%, 100 million divided by 1 billion. Furthermore, to grow its profits, it needs to build another factory. Growth requires huge amounts of new capital. Now consider Company B, a software company with a dominant market position. To generate its $100 million in profit, it needs only $200 million of invested capital, mostly for past research and development. Its ROIC is a spectacular 50%. 100 million divided by 200 million. Even better, to grow its profits, it doesn't need to build a new factory. It can simply sell more copies of its existing software, which costs almost nothing to replicate. Its growth is capital light. This difference is everything. Company B can take its $100 million in profit, reinvest a small portion back into the business to fund growth, and return the rest to shareholders or use it for acquisitions. Company A must pour most of its profits back into just maintaining its existing factories and funding its slow, expensive growth. Over a decade, Company B will have generated vastly more cash for its owners, and its intrinsic value will have compounded at a much higher rate. This is precisely the financial dynamic that Munger saw in See's Candies and Coca-Cola. They were high ROIC businesses. They didn't need to constantly consume shareholder capital to grow. They were capital creators, not capital consumers. When you build a portfolio of high ROIC businesses, the effect is magical. The businesses themselves are doing the heavy lifting of compounding your wealth for you. You are not just relying on the stock market to re-rate the PE multiple of your stocks. You are benefiting from the underlying, fundamental value creation that is happening inside the businesses you own, year after year. This is the ultimate financial connection, the direct translation of a business's quality into tangible, long-term portfolio growth. The Munger shift has two equally important parts. Buy a wonderful company is the first, but at a fair price is the second. This second clause is the anchor of discipline that prevents quality investing from devolving into the kind of growth at any price speculation that defines market bubbles. The paradox is that exercising price discipline, even for the best companies in the world, is often the hardest part. The perfect historical laboratory for this principle was the dot-com bubble of the late 1990s. From 1995 to early 2000, the stock market, particularly the Nasdaq index, went on a parabolic run, fueled by excitement over the new possibilities of the internet. Companies with .com in their name, many with no revenues and no profits, saw their stock prices double, triple, and quadruple in a matter of months. In the midst of this euphoria, Warren Buffett and Berkshire Hathaway looked like relics from a bygone era. They famously refused to buy the high-flying tech stocks of the day, like Cisco, Intel, or Microsoft. Buffett was openly mocked. He was called a dinosaur, a man who didn't get it. A famous Barron's cover story in 1999 was titled, "Warren, What's Wrong?" The article suggested his value-oriented brick-and-mortar approach to investing was dead, made obsolete by the new digital paradigm. The pressure on Buffett was immense. His own shareholders were questioning him. He was dramatically underperforming the soaring market indices. It would have been easy to cave, to buy a few tech stocks just to keep up, to play the game. But Buffett, anchored by his and Munger's discipline, held firm. His reasoning was twofold. First, these businesses were outside his circle of competence. He admitted he had no way of knowing which of the hundreds of tech companies would be the long-term winners. He couldn't confidently project their cash flows out for 10 or 20 years, so he couldn't determine their intrinsic value. Second, and more importantly, even for the companies that were clearly emerging as winners, like Microsoft and Cisco, their stock prices were discounting a future that was not just optimistic, but borderline utopian. They were trading at prices that left no room for error, no margin of safety. He understood they were wonderful businesses, but the market was not offering them at a fair price. It was offering them at a perfect price, a price that assumed decades of flawless execution and uninterrupted dominance. So Buffett did nothing. He sat on his hands holding billions in cash while the party raged around him. And then, in March of 2000, the bubble burst. The Nasdaq crashed. The dot-com darlings, the new paradigm stocks, fell by 80%, 90%, or in many cases, 100%, going bankrupt. The investors who had mocked Buffett were wiped out. Buffett, with his cash hoard intact, was vindicated. His refusal to overpay, his unwavering discipline on price, had preserved Berkshire's capital and positioned him to take advantage of the bargains that would emerge in the aftermath. It was perhaps the greatest demonstration in financial history that the quality of the business is only half the equation. The price you pay determines your ultimate return. The psychological storm that Buffett navigated during the dot-com bubble was a fire hose of cognitive biases, and his ability to stand against it is a masterclass in emotional discipline. The single most powerful force at play during any market mania is the fear of missing out, or FOMO. This is a deep, primal fear rooted in our social nature. When we see our friends, our neighbors, and the experts on television getting rich from a particular asset class, it triggers a powerful anxiety that we are being left behind. It feels less like an investment decision and more like a social imperative. To not participate is to risk being the fool who missed the golden opportunity. This FOMO is what drives rational people to abandon their principles and buy wildly overvalued assets near the top of a bubble. Compounding this is the overconfidence bias. As the bubble inflates, the people who bought in early become evangelists. Their initial success reinforces their belief that they are geniuses. They mistake luck for skill. They believe that, quote, "this time it's different," that the old rules of valuation no longer apply. This narrative of a new era is incredibly seductive, and it provides the intellectual cover for paying insane prices. Buffett's antidote to these poisons was his unwavering commitment to his own internal scorecard. He was not trying to beat the market in any given month or year. He was focused on executing his process, day in and day out, based on principles that he knew worked over the long term. He effectively insulated himself from the social pressure by defining success on his own terms. His adherence to his circle of competence, was a powerful tool against overconfidence. By honestly admitting what he didn't know, he prevented himself from being swept up in the hype of an industry he didn't understand. This is a form of intellectual humility that is incredibly rare, especially among successful people. He didn't feel the need to have an opinion on everything. He was comfortable waiting for the opportunities that fit his specific, narrow criteria. The discipline to hold cash and do nothing while others are getting rich is perhaps the most difficult psychological feat in all of investing. It requires a level of patience and long-term perspective that is almost superhuman. But it is the ultimate defense against the madness of crowds. Buffett understood that the market is a manic-depressive business partner. Some days it is euphoric and offers to sell you its shares at ridiculous prices, and other days it is despondent and offers to sell you those same shares at a steep discount. His job was simply to ignore the mood and transact only when the price made sense from a long-term business perspective. This emotional detachment is the bedrock of buying wonderful companies at a fair price. To turn this discipline into a repeatable process, we need a practical mental model for valuation. The goal is to determine a fair price for a wonderful company, which then allows us to demand a discount to that price, creating our margin of safety. While professional analysts use complex discounted cash flow (DCF) models, the underlying logic can be simplified into a blueprint that anyone can use. This is the business owner's valuation model. Step 1 is to estimate the company's owner earnings for the next 10 years. Owner earnings is a concept Buffett popularized, and it's a more realistic measure of a company's cash-generating ability than reported net income. A simple proxy for it is net income plus depreciation and amortization, average capital expenditures. You are trying to figure out how much cash the business will actually be able to give to its owners over time. Look at the company's past 10 years of financial statements to see how fast owner earnings have grown, and then make a conservative estimate for the next decade. For a stable, wonderful company, perhaps you project 7% to 10% annual growth. For a faster-growing one, maybe 12% to 15%. Be realistic and conservative. Step 2 is to determine a terminal value. You can't project earnings forever, so at the end of your 10-year forecast, you need to estimate what the business will be worth. A simple way to do this is to take the owner earnings from year 10 and apply a conservative multiple to it. For a high-quality, stable business, a multiple of 10 to 15 times its earnings in a decade is a reasonable starting point. This gives you a lump sum value for the business at the end of your forecast period. Step 3 is to discount all those future cash flows back to the present. This is the most crucial step. A dollar received 10 years from now is worth less than a dollar in your pocket today. You need to choose a discount rate, which is the annual rate of return you demand on your investment. A good starting point is 10%, which is roughly the long-term average return of the stock market. You take each of your 10 years of projected owner earnings plus the terminal value, and you discount them back to today's value using your chosen discount rate. There are simple online calculators that can do this math for you. Step 4 is to calculate the total intrinsic value and apply a margin of safety. Once you add up all the discounted cash flows, you will have an estimate of the company's intrinsic value per share. This is what you believe the business is truly worth today. But you don't buy it at that price. You apply a margin of safety. You demand a discount. You might decide you will only buy this wonderful company if its stock price falls to 75% of your calculated intrinsic value, or perhaps 50% if you want to be extremely conservative. This margin of safety is your protection against being wrong in your forecasts. It's the difference between a fair price and a wonderful price. This process forces you to think like a long-term business owner, not a short-term stock speculator. It grounds your decisions in the economics of the business, not the whims of the market. The antithesis of this disciplined, valuation-driven approach is the story stock investor. This is the person who falls so deeply in love with a company's narrative, with its visionary CEO and its world-changing potential, that they come to believe valuation is irrelevant. They are the ones who suffer the most when a market bubble pops, because they learn the painful lesson that even the greatest companies can be terrible investments if you pay too high a price. the mindset of the story stock investor is one of pure extrapolation. They take a company's exciting narrative, "We are the future of transportation, we are revolutionizing finance," and they assume a straight line of uninterrupted success far into the future. They are not buying a stream of discounted future cash flows, they are buying a dream. Their vocabulary is devoid of terms like margin of safety or return on invested capital. Instead, they talk about total addressable market, disruption, and paradigm shifts. The danger is that this narrative can be intoxicating, especially when the company's stock price is rising rapidly. This price appreciation creates a feedback loop of social proof, confirming the story investors' belief that they are right. They mock the old-school investors who talk about PE ratios as being unable to grasp the brilliant future ahead. A classic historical example is Cisco Systems during the dot-com bubble. In March 2000, Cisco was undeniably a wonderful company. It was the dominant provider of the plumbing for the internet. It had a strong moat, high margins, and brilliant management. It was a true quality business. But its stock price had been bid up to such stratospheric levels that it became the most valuable company in the world, with a market capitalization over $500 billion. At its peak, investors were paying more than 100 times the company's earnings. To justify this price, Cisco would have had to grow into one of the largest and most profitable companies in human history, and then continue growing at an incredible rate for decades. The price discounted not just a rosy future, but a perfect one. When the bubble burst, Cisco's business did not collapse. It remained a great, profitable company. But its stock price collapsed. It fell more than 80% from its peak. An investor who bought Cisco at the top in 2000, even though they had correctly identified a wonderful business, would have had to wait over 20 years just to get back to even. This is the devastating consequence of ignoring valuation. The story stock investor learns the hard way that you can be right about the business and still lose a catastrophic amount of money if you are wrong about the price. Price is the anchor that connects a great story to a great investment. Without it, you are simply adrift in a sea of narrative, vulnerable to the changing tides of market sentiment. The direct financial connection between the price you pay and your future returns is not an abstract theory. It is a mathematical certainty. The entry multiple you pay for a stock is the single most important determinant of your long-term capital gains, even for the highest quality business in the world. Let's run a simple but powerful quantitative example to illustrate this. Imagine a wonderful company, let's call it Quality Co. You have done your homework. It has a deep moat, great management, and it is projected to grow its earnings at a steady 15% per year for the next decade. Now let's consider two investors. Investor A is disciplined. He waits patiently until a market correction offers him the chance to buy Quality Co. at a price-to-earnings PE ratio of 20. He invests $10,000. Investor B is a bit more impulsive. He loves the company's story and, caught up in the excitement, he buys Quality Co. at a PE ratio of 40. He also invests $10,000. Both investors are buying the exact same wonderful business with the exact same excellent future prospects. Now let's fast forward 10 years. Quality Co. has performed exactly as expected, growing its earnings by 15% annually. At the end of the decade, the market has sobered up a bit and decides that a fair, long-term PE multiple for a mature, high-quality business like this is 20. So what are the financial results for our two investors? For Investor A, his initial investment was based on a PE of 20, and the exit multiple is also 20. His return will come purely from the 15% annual growth in the company's earnings. His $10,000 will have grown to approximately $40,000 over the decade, a solid 4x return, or a 15% annualized gain. He is very happy. Now look at Investor B. He also benefited from the same 15% annual earnings growth. However, he started at a PE of 40, and the multiple at the end of the period contracted to 20. This multiple compression acts as a massive headwind against his returns. The 15% annual growth in the business was completely offset by the 50% decline in the valuation multiple. His $10,000 investment is now worth only about $20,000, a 2x return, or a 7% annualized gain. He has captured less than half of the return that Investor A did, despite owning the exact same wonderful business for the exact same period. This mathematical reality is inescapable. The high price he paid acted as an anchor, dragging down his future returns. The initial valuation is the launching pad for your investment. A low valuation gives you the tailwind of both business growth and potential multiple expansion. A high valuation forces you to run into the headwind of potential multiple contraction, which can neutralize even the most spectacular business performance. This is why the discipline to wait for a fair price is not just a defensive measure, it is the ultimate offensive weapon for maximizing long-term wealth. The final pillar of the Munger philosophy, the one that ties everything together, is temperament. Identifying a wonderful company and buying it at a fair price is a powerful start, but it is utterly useless if you do not possess the patience and emotional fortitude to hold it for the long term. The greatest returns are not made in the buying or the selling, but in the waiting. This is perhaps the most difficult skill of all, as it requires a cultivated inactivity that runs contrary to every instinct in our hyperactive world. The quintessential story of this principle is Warren Buffett's investment in the Washington Post Company in 1973. At the time, the stock market was in the midst of a brutal bear market. The Nifty 50 stocks, the darlings of the previous era, were collapsing. The Washington Post, despite being a premier media franchise with a near monopoly position in the nation's capital, saw its stock get hammered. Buffett, applying his now-honed, quality-focused lens, saw a wonderful business. It had a powerful brand, a deep moat in its local market, and was run by the brilliant and trustworthy Katharine Graham. He calculated that the entire business was worth at least $400 million, yet due to the market panic, its stock market valuation had fallen to a mere $80 million. It was a wonderful company being offered at an incredibly wonderful price, so Buffett invested about $11 million, buying up a significant chunk of the company. This is where the story truly begins. A lesser investor would have expected an immediate rebound. But the market is not so accommodating. Over the next 2 years, the bear market continued to grind on, and the stock of the Washington Post fell by another 50% after Buffett had bought it. His $11 million investment was now worth closer to $5 or $6 million. The psychological pressure was immense. The consensus view was that he had made a terrible mistake. The financial press was questioning his judgment. He was experiencing a significant, painful paper loss. This is the moment that separates the amateurs from the legends. An ordinary investor seeing their stock down 50% would have panicked. They would have questioned their analysis, assumed they missed something, and sold their shares to cut their losses. Their decision would be driven by the pain of the stock price movement. Buffett, however, did not focus on the stock price. He focused on the business. He continued to read the company's reports. He talked to management. He asked himself, has the long-term value of the Washington Post franchise deteriorated? Is it a less dominant newspaper today than it was a year ago? The answer was clearly no. The business was fine. It was the stock market that was sick. Because his conviction was rooted in the quality of the underlying enterprise, the daily fluctuations of its stock price were irrelevant noise. So he did the hardest thing of all. He did nothing. He held on. And then he held on for the next 30 years. That initial $11 million investment, which looked so foolish in 1974, compounded into a stake worth over $1.5 billion. It became one of the legendary 100 baggers that formed the bedrock of Berkshire Hathaway's fortune. This story is the ultimate testament to the power of patience. The Munger shift is not a short-term trading strategy. It is a long-term business ownership philosophy. Its magic is only unlocked over periods of decades, not quarters, and that requires a temperament forged in steel. The human brain is simply not wired for long-term investing. Our evolutionary history has programmed us with a set of cognitive biases that make the patient ownership of wonderful businesses an incredibly difficult psychological task. The two most powerful of these biases are myopic loss aversion and the action bias. Myopic loss aversion is a double-barreled shotgun aimed directly at your portfolio. The loss aversion part refers to the well-documented psychological finding by Daniel Kahneman and Amos Tversky that humans feel the pain of a loss roughly twice as powerfully as they feel the pleasure of an equivalent gain. A $10,000 loss hurts twice as much as a $10,000 gain feels good. This makes us inherently risk-averse and terrified of seeing red in our brokerage accounts. The myopic part refers to our tendency to check our portfolios too frequently. The more often you look at your stocks, the more likely you are to see a temporary loss, and the more pain you will feel. This combination is lethal. An investor who checks his portfolio daily will feel the intense pain of loss aversion on almost half of all days, even in a bull market. This constant psychological pain wears you down, making you far more likely to sell a great company during a normal, healthy market correction simply to make the pain stop. The action bias is our innate, ingrained belief that doing something is better than doing nothing. In our evolutionary past, this was a survival trait. If you heard a rustle in the bushes, it was better to run, action, than to stand still and analyze, inaction. In the modern world of investing, this bias is a portfolio killer. We see a news headline, we hear a pundit's prediction, we see a stock moving, and we feel an overwhelming compulsion to act, to buy, to sell, to trim, to rebalance. The idea of simply sitting on your hands while the world churns around you feels lazy and irresponsible. Wall Street's entire business model is built on feeding this action bias. The constant stream of breaking news, analyst upgrades and downgrades, and minute-by-minute market commentary is designed to make you feel that you must constantly be doing something. But true quality investing is the art of cultivated inactivity. It is the wisdom to know that for a long-term owner of a great business, the correct action on most days is no action at all. Overcoming these deep-seated biases requires a conscious and deliberate rewiring of your brain. It requires building a system that distances you from the noise and forces you to focus on the long-term signal of business performance, not the short-term noise of stock prices. The blueprint for cultivating this essential patience is not about complex financial modeling, it is about psychological architecture. It is about designing an investment process that protects you from your own worst instincts. This is the sit-on-your-ass portfolio management strategy, a Munger-inspired model for long-term ownership. Step 1 is to build a concentrated, high-conviction portfolio. Instead of owning 100 different stocks you barely know, you should aim to own just 10 to 15 wonderful businesses that you have researched exhaustively and understand inside and out. This concentration forces you to have real conviction. When you own a significant stake in a company, you are far more likely to think like an owner. You will weather the inevitable downturns with more fortitude because you have a deep, fundamental belief in the long-term value of the business, a belief that isn't easily shaken by market noise. Step 2 is to establish your selling criteria before times you buy. This is a critical psychological trick. Sit down with a piece of paper and write down the only acceptable reasons you would sell this business. These reasons should have nothing to do with the stock price. They should be related to the business itself. For example, I will sell if the company's core competitive moat shows clear signs of deterioration, or I will sell if management is replaced by a team I do not trust, or I will sell if the leadership begins to allocate capital irrationally, or finally, I will sell if I find a different, clearly superior investment opportunity that offers a much higher expected return. By pre-committing to these rational selling criteria, you create a defense against future emotional decisions. When a stock you own is down 30% and you feel the panic rising, you can pull out this piece of paper and ask, has any of my predetermined selling criteria been met? If the answer is no, then the only reason you want to sell is emotion, and that is not an acceptable reason. Step 3 is to divorce yourself from the daily noise. This means deleting the stock market app from your phone. It means not watching financial news channels. Your primary source of information about the companies you own should be their own quarterly and annual reports. Your job is to monitor the health of the business, not the mood of the market. Aim to spend your time reading the words of the CEO, not the opinions of a television pundit. Think of yourself as a business partner who gets an update from the management team 4 times a year. The rest of the time, you let them run the business. Step 4 is to reframe your time horizon. Do not think in terms of months or quarters. Think in terms of decades. When you buy a stock, imagine you are buying a private family business that you intend to pass on to your children. The stock market is not a casino. It is a venue that allows you to buy pieces of real, operating enterprises. Adopting this mindset of a private business owner is the ultimate key to unlocking the patience required for long-term compounding. The antithesis of the patient, long-term owner is the hyperactive trader. This individual represents the final and most self-destructive path in the market, the one that guarantees underperformance over any meaningful period. The hyperactive trader is the living embodiment of the action bias, a person who confuses activity with accomplishment. Their screen is a kaleidoscope of flashing tickers, charts with dozens of indicators, and a constantly updating newsfeed. They are not investing in businesses, they are renting stocks. Their holding period is measured in days, hours, or even minutes. They are perpetually chasing the latest hot trend. One week they are an expert in biotechnology because they read an article about a new drug trial. The next week they are all in on a cryptocurrency they heard about on social media. They have no circle of competence, no deep knowledge of any single business. Their entire strategy is based on trying to predict the short-term direction of stock prices based on news flow and market sentiment, a game that not even the most sophisticated supercomputers have been able to win consistently. This constant churning of their portfolio is financially ruinous for 2 primary reasons. First, transaction costs. Every time they buy and sell, they are paying a commission to their broker. While commissions are low today, for a truly hyperactive trader, these small cuts can add up to a significant drag on performance over the course of a year. It's like death by 1,000 paper cuts. They are consistently giving up a piece of their capital just for the privilege of being in motion. The second, and far more devastating, cost is taxes. Because their holding periods are so short, any gains they make are taxed as short-term capital gains at their highest marginal income tax rate. This creates a massive, insurmountable headwind. They are playing a game where the government automatically takes a 30% to 40% cut of all their winning bets, while their losing bets are only partially deductible. They are in a constant battle to overcome this huge tax disadvantage, a battle they are almost certain to lose over time. The hyperactive trader is their own worst enemy. They are so caught up in the thrill of the game, the adrenaline rush of the quick profit, that they fail to see they are simply transferring their wealth to their broker and the government. They never allow the true magic of investing, the patient, tax-efficient compounding of capital within a wonderful business, to even begin. They have chosen the path of maximum effort, maximum stress, and minimum return. The ultimate, quantifiable benefit of adopting the Munger philosophy of long-term ownership is found on your tax return. The tyranny of taxes and transaction costs is the single most destructive yet least understood force working against the average investor's quest for financial freedom. A simple mathematical comparison reveals the staggering power of patience. Let's imagine 2 investors, Investor A, the hyperactive trader, and Investor B, the patient owner. Both are brilliant stock pickers and manage to generate a gross return of 20% per year on their initial $100,000 portfolio. The only difference is their strategy. Investor A, the trader, realizes his 20% gain at the end of each year. He sells his winners, pays his taxes, and reinvests the remainder. Because his gains are short-term, let's assume he pays a combined federal and state tax rate of 40%. So each year, his $20,000 gain is reduced by an $8,000 tax bill. He is left with a $12,000 net gain, a 12% net return on his capital. Investor B, the patient owner, also generates a 20% annual return, but it is all unrealized. He owns a wonderful business whose value is compounding at 20% per year, but he doesn't sell. He sits on his hands, he pays no taxes. His entire investment is left to compound tax-deferred. Now let's look at the results after 30 years. Investor A, the trader, with his 12% net annual return, will have turned his initial $100,000 into approximately $2,996,000. A fantastic result. To be sure, he feels very successful. But now let's look at Investor B. His $100,000, compounding at an untaxed 20% per year for 30 years, has grown into $23,737,000. That is nearly $24 million. It is almost 8 times more money than the equally skilled trader. The difference is not skill. The difference is strategy. Investor B allowed the eighth wonder of the world to work its uninterrupted magic. He kept the government as a silent, non-participating partner for 30 years, allowing every dollar of his earnings to generate more earnings in an ever-accelerating snowball of wealth. Even if Investor B finally sells his entire position in year 30 and pays a long-term capital gains tax of, say, 25%, he would still be left with over $17 million, vastly more than the hyperactive trader. This is the direct, quantifiable, life-altering financial connection of the Munger shift. It is a philosophy that minimizes friction, maximizes the power of compounding, and aligns your strategy with the mathematical laws of wealth creation. It is the surest path from active, effortful earning to true, passive, and lasting financial freedom. You have made it through a deep and rigorous installation of a new mental operating system. For the past hour, we have journeyed from the smoke-filled backrooms of cigar butt investing to the sunlit highlands of owning wonderful, compounding businesses. You now possess the complete blueprint of the Munger shift, the single most valuable intellectual pivot in modern financial history. You understand the foundational flaw of focusing on cheapness, the psychological biases that trap the 99%. You have the anecdote of C's Candies as your guiding star, the checklist for identifying a wonderful company, the framework for recognizing economic moats, the discipline to demand a fair price, and the final, crucial understanding that patience is the catalyst that transforms it all into generational wealth. This is not just theory. This is a powerful, actionable tool that can fundamentally change your financial trajectory. But mastering this model, as critical as it is, represents the mastery of only one piece of a much larger, interconnected system. You have learned how to identify the gold mines. You now have the map that shows you where the highest quality, most profitable businesses in the world are located. This is a monumental achievement. However, the map is not the entire treasure. The second, and arguably more advanced level of the game is capital allocation. It is the art and science of taking the gusher of cash that these wonderful businesses produce and deciding, with supreme intelligence, where to point that fire hose of capital next. How do you decide when to make a small bet versus when to back up the entire truck? How do you structure a portfolio of these great businesses to maximize returns while managing risk? How do you think about using debt or deploying cash during a crisis? The Munger shift teaches you what to buy. The art of capital allocation teaches you how and how much and when. It is the engine that takes the fuel from your wonderful businesses and uses it to build an empire. The video that is now appearing on your screen is not just another piece of content. It is the missing link. It is the second volume in the library of wealth. It is the bridge from identifying quality to multiplying capital. It is the blueprint that connects the what to the how. Watching it is not a passive act of consumption. It is an active decision to continue your ascent, to build upon the powerful foundation you have just laid. The journey of 1,000 miles begins with a single step, and you have just taken a giant one. But the summit is still higher. The choice before you is simple. You can remain here, content with your new map, a skilled prospector who knows how to find gold. Or you can click and learn the logistics of extraction, refinement, and reinvestment. You can learn to become the king of the entire mountain. If you are serious about this journey, if your ambition is not just to do better but to achieve true mastery and financial freedom, then the next piece of your mental arsenal, the next part of the map, is waiting for you right there on your screen. The choice is yours. Complete the system,